In this video, I am going to discuss about absorption costing. This is also known as the full costing. Absorption costing or full costing is a traditional costing technique which calculates the total production cost per unit. This is really important. Under this technique, management accountants calculate the total production cost per unit. Both fixed and variable production costs are considered under this technique. This is also really important. Fixed and variable production costs will be considered under this technique. Non-production costs will not be considered. Overheads absorption rate is used to absorb the fixed production overheads to the cost unit. This is the overhead absorption rate. Inventory is valued at the full cost under absorption costing. This is the absorption costing cost card, which means this is the format management accountants use to calculate the total production cost per unit. This includes all the variable and fixed production cost per unit, direct material per unit, direct labor per unit, variable production overhead per unit, fixed production overhead per unit. So finally, we can calculate the full cost per unit. This is also known as the absorption cost per unit. Using the OAR, we can calculate the fixed production overhead per unit. So this absorption costing cost card can use to calculate the full cost per unit, which is this. Using this value, we can value the inventory. Meaning this is the total production cost per unit of the inventory. If the inventory has 1000 units, we can simply multiply this value by the total production cost per unit. So the valuation of the inventory is $7,000. Using the absorption costing cost card, we can come up with this formula to calculate the full production cost per unit, which is equal to direct cost per unit plus variable production overhead per unit plus fixed production overhead per unit. This cost is calculated by using the OAR, overhead absorption rate. As we discussed earlier, non-production overheads are not considered for full costing. These are the common non-production costs in businesses: selling and distribution, advertising and marketing, administration costs. These are non-production overheads. So we do not consider these costs under full costing because we only consider the production costs. It can be either variable or fixed. Now let's do this example. Company A manufactures product X. Following are the costs that incur to produce a unit of X. Calculate the full production cost per unit, which means we have to calculate the full cost per unit. This is equal to direct cost per unit plus variable production cost per unit plus fixed production overheads per unit. So now let's go through these costs and identify whether we can use these costs to calculate the full cost per unit. Direct material cost. This is relevant. Direct labor hours per unit. And they have given the direct labor cost per hour. So this is relevant. Fixed production overhead cost per unit. This is relevant. Direct expenses. This is also relevant. Selling and distribution cost per unit. This is not relevant because this is a non-production overhead. We do not consider non-production overheads under full costing. Now we can calculate the full production cost per unit, which is equal to 1.5 plus 1.5 multiplied by 6. This is because it will take 1.5 hours to manufacture a unit of X. So 1 hour will cost $6. So the direct labor cost per unit is this, plus $2 plus $3. $15.5. This is the full production cost per unit of X. As now you know, this is the formula we can use to calculate the OAR, fixed production overhead absorption rate. We use the budgeted values. Budgeted total fixed production cost divided by the budgeted activity level. This budgeted activity level is also known as the base. Usually, the question will directly indicate what is the base activity level is. If not, follow this best practice. This means in the exam, the base activity level will be directly indicated. If not, use these best practices. Budgeted activity level can be either production units, labor hours of machine hours. This means we can select either of these base values for the denominator. If all three are given, select production units as the base. This means if the question is giving you these three activity levels, give the priority to production units, which means use the production units in the denominator of the OAR calculation. If the labor hours and machine hours are given, select the highest value as the base. This means let's assume the question has given labor hours as 100 hours and machine hours as 120 hours, and question is not directly indicating what is the base activity level is, which means we have to select a base activity level. So how we can select an accurate base activity level? In this case, we select the highest value as the base value. So 120 is the highest value. So we select the machine hours as the base activity. Let's say the question is giving you labor hours as 100 hours and machine hours as 80 hours. Now what activity level would you select as the base value? 100 is the highest value. So we select the labor hours as the activity level. This section is really important when it comes to full costing. Mostly a predetermined OAR is used in absorption costing using a budgeted total fixed production cost and budgeted activity level. This will result in over under absorption. Let's discuss about the over and under absorption after the example questions. Now let's do these examples so you can understand how to calculate the FOAR. Company A is budgeted to produce 1200 units and the budgeted fixed production cost is 24,000 and budgeted fixed selling overhead is $3,600. What is the FOAR? So the FOAR is equal to budgeted total production fixed cost divided by budgeted activity level. So in this example, the only activity level they have given is the units 1200. So we can directly use the 1200 activity level as the budgeted activity level. So what is the budgeted total fixed production cost? Which is 24,000 plus 3,600. Is it? No, it is not. This 3,600 is not a production cost. This is a non-production cost. So we do not use the budgeted fixed selling overhead to this calculation. So the FOAR is equal to $20 per unit. Now let's do this example. Company A is budgeted to produce 1200 units and budgeted direct labor hours and machine hours are 250 hours and 300 hours respectively. The budgeted fixed production cost is $24,000 and budgeted fixed selling overhead is 3,600. What is the FOAR? Now we know in order to calculate the FOAR, we do not consider the non-production costs. So this 3600 is not relevant. Now you can see in this example, they have given the units, labor hours and machine hours as activity levels. So what activity level we select as the base activity level? So if you can remember, we have to give the priority to the production units. So we select the 1200 units as the base activity level. So the FOAR is equal to 24,000 divided by 1200. So this is equal to $20 per unit. Now let's do this example. Budgeted direct labor hours and machine hours are 250 hours and 300 hours respectively. The budgeted fixed production cost is 24,000 and budgeted fixed selling overhead is 3,600. What is the FOAR? Now we know we do not consider this 3,600 because this is a non-production overhead cost. And now they have given the labor hours and the machine hours as activity levels. What activity level we select as the base activity level? If you can remember, we select the highest value as the base activity level. So 300 hours is the highest value. So the machine hours will be the base activity level in this calculation. So FOAR is equal to 24,000 divided by 300. This is equal to $80 per machine hour. I hope now you understand how to calculate the FOAR using different base values. Now there is a very important thing to note here because as you can see this FOAR is a per machine hour value. We cannot use this value directly to calculate the full cost per unit. Let's go back to the costing card. Here is the absorption costing cost card. As you can see, we are calculating the total production cost per unit. So all of these costs should be per unit value. So direct material per unit, direct labor per unit, variable production overhead cost per unit, and fixed production overhead per unit. So we cannot use the per machine hour or per labor hour value here. We have to convert those values into a per unit value. So if the FOAR is per machine hour or per labor hour, we have to convert these values into a per unit value. Then only we can use this value to calculate the full production cost per unit. If the FOAR is a per unit value, we can directly use this value. Otherwise, we have to convert the FOAR into a per unit value. I hope it is clear now. This is really important because if you forget to convert it to a per unit value, you will get an incorrect answer. So let's go back. Let's say if the question is directly asking you to calculate the FOAR, this answer is correct. But if you have to calculate the total production cost per unit, you have to convert this value into a per unit value. Let's say the question is giving you that one unit will take 2 machine hours to produce. So what we have to do is we have to calculate the per unit value. So it will take 2 machine hours. So 2 multiplied by 80. 80 is the per machine hour value, which is this value. So this is equal to 160 per unit. So this is the value it will take to produce a 1 unit. So this 160 per unit value can be used to calculate the absorption costing per unit value here. So the fixed production overhead cost per unit is equal to 160 for the example we just did. Now let's calculate the over and under absorption. Usually businesses absorb fixed production costs to cost units under full costing using a predetermined overhead absorption rate OAR. We just discussed about how to calculate the OAR. meaning this OAR will be calculated at the beginning of the year using budgeted values. This basically means OAR is an estimate value. This is not an actual value. At the end of the year, the actual fixed production cost and the actual activity level can be identified accurately, and these may be different from the budgeted values. In order to calculate the actual profit for the past year, the over under absorption should be calculated. This is important. We only need to calculate the over and under absorption if we want to calculate the actual profit. If we don't want to calculate the actual profit, the over and under absorption will be not necessary. But in the context of real businesses, this is really important. As now we know, this is the OAR calculation. OAR is equal to budgeted total fixed production cost divided by the budgeted activity level. This is the base. Base can be either units, labor hours or machine hours. We just discussed about this earlier. This is the formula we can use to calculate the over or under absorption, which is equal to overheads absorbed minus the actual fixed cost. We can calculate this overheads absorbed amount by multiplying the actual production units by the FOAR. So this is the final formula we can use to calculate the over or under absorption, which is equal to actual production units multiplied by the FOAR, then deduct the actual fixed cost. There are three instances under over or under absorption. If actual fixed cost is higher than the absorbed fixed cost, it is an under absorption. If actual fixed cost is equal to the absorbed fixed cost, there is no variance. If actual fixed cost is less than the absorbed fixed cost, it is an over absorption. This is how we treat the over or under absorption. Treat over absorption as an income, which means treat this value as a positive value. Treat under absorption as an expense, which means this is a negative value. This is why we use these parentheses in order to indicate that this is a negative value. Let me explain this to you. Let's say the actual fixed cost is 10,000. Let's indicate as this. And the absorbed fixed cost is equal to 800, which is below this actual value. In other words, this is under the actual value, which is known as the under absorption. If the absorbed fixed cost is 1200, this is above the actual value. In other words, this is over the actual value. So we treat this as a positive value. This is a negative value. Over absorbed means we have absorbed over the actual value, which means we have absorbed extra fixed cost. Under absorption means we have not absorbed fixed costs enough because the actual value is higher than the absorbed value. Now let's do this example. Budgeted fixed production cost is 250,000. Budgeted production units is 50,000. Actual fixed production cost is 230,000. Actual production units is 45,000. Calculate the over or under absorption. Over or under absorption is equal to actual units multiplied by the FOAR minus actual fixed production cost. So first of all, we have to calculate the FOAR. FOAR is equal to budgeted total fixed production costs divided by the budgeted activity level. So this is equal to budgeted fixed production cost is 250,000 divided by the budgeted activity level. Budgeted activity level is 50,000. This is equal to $5 per unit. Now we can calculate the over or under absorption. Actual production unit is multiplied by FOAR. FOAR is 5 minus actual fixed production cost, which is 230,000. This is equal to minus $5,000. So this is an under absorption. So under absorption is equal to $5,000. If this is a positive value, which means it is an over absorption. Since this is a negative value, it is an under absorption. We treat under absorption as an expense, which means a negative value. If it is a positive value, we treat this as an income. Another important thing to note is that students will calculate the over or under absorption by just taking the difference between the actual production cost and the budgeted fixed production cost. This is incorrect. This will give you an incorrect answer. What we have to do is we have to calculate the absorbed fixed cost using this, then take the difference between the actual cost. So remember this point. We have to calculate the FOAR first in order to calculate the absorbed fixed cost. Then we can take the difference between the actual fixed cost. This is the absorption costing profit statement, meaning here we use the full costing when it comes to valuation the inventory. So why do we need a costing system? Because management accountants want to value the inventory and they want to calculate the cost and they want to set a selling price. This is why businesses need costing system. Under absorption costing, the full production cost will be calculated. Using this absorption costing method, management accountants use this profit statement. Sales revenue. This is easy to calculate. This is the number of sales units multiplied by the selling price per unit. And then the cost of sales have to be deducted from the sales revenue. It is consist of these three segments: opening inventory, production cost and closing inventory. We add the opening inventory and production costs, then deduct the closing inventory. So we can calculate the cost of sales figure, which is this. Then we have to adjust for the over or under absorption. We discussed earlier how to calculate the over or under absorption. If you can remember, if it is an over absorption, we treat this as an income, which means we are going to add this value, which is this. If it is an under absorption, we treat this as an expense, which is this. We deduct this value. So this is very important. If it is an over absorption, add this value. If it is an under absorption, deduct this value. After that, we can calculate the gross profit. Then we can deduct all the non-production fixed costs. These are the non-production fixed costs. So finally, we can calculate the net profit. Let's discuss about how to calculate the cost of sales. These segments. So the cost of sales is equal to opening inventory plus production cost minus the closing inventory. So what is opening inventory? Opening inventory is equal to inventory at the beginning of the year. Or this is the inventory at the end of the previous year. Production units is the number of units produced during the year. This is easy to understand. Closing inventory is the inventory level at the year end, which means this is the number of units which were not sold during the year. So this closing inventory figure will be the opening inventory figure for the next year. Let me give you an example. Let's say company A starts their business 1st of January 2000. 1st January 2000. This is the starting day of the business. At the starting date, they do not have any inventory. because they haven't produced any inventory yet. So during the year, so now it is 31st of December 2000. During the year, they have produced 1000 units. And at the end of the year, they have 200 units left. This is the closing inventory. So now let's calculate the cost of sales for this company for the year 2000. So the opening inventory was 0 and they have produced 1000 units and they have 200 units left. This is the closing inventory, which means they have sold 800 units during the year. Now let's say during the second year, this is now 31st of December 2001. During this year, they have produced 700 units. And remember, these 200 units at the year end of 2000 will be the opening inventory of 2001, which is this. Inventory at the end of the previous year will become the opening inventory of the next year. So now let's say they do not have closing inventory. So closing inventory will be 0. So the cost of sales or the number of sales units during the year is equal to opening inventory, which is 200. They have produced 700 minus 0, which means they have sold 900 units during the year. This is how we calculate the number of sales units using the opening inventory, production units and closing inventory. This is really important because these figures are really important when it comes to calculating the net profit, because this whole section consists of opening inventory, production cost and closing inventory, which is known as the cost of sales. We just discussed about this. This is the sales units. Sales units is equal to the opening inventory plus the production units during the year minus the closing inventory at the year end. So using this sales units figure, we can calculate the cost of sales, which is equal to sales units multiplied by the full cost per unit. So this final figure will be the figure here. This is the cost of sales. As I explained you earlier, this is why costing techniques are important, because we need to know the cost per unit in order to value the inventories, because based on this value we value the inventory. So usually we calculate the opening inventory as opening inventory units multiplied by the full cost, and the production cost is equal to the production units multiplied by the full cost, and the closing inventory is equal to closing inventory units multiplied by the fixed cost per unit. This is why the cost per unit is important, because we need to value the inventory. I hope this is clear now. Now let's do these examples. Closing inventory for 2015 was 600 units. During the year 2016, Company A produced 900 units. Closing inventory for 2016 was 200 units. If the full cost per unit is $13, what was the cost of sales for 2016? We can calculate the cost of sales either by using the total amount or either by calculating the sales units. First, let's calculate the cost of sales using the total values. So the cost of sales is equal to opening inventory plus production cost minus closing inventory. So the opening inventory is equal to 600 units multiplied by 13, because the closing inventory for 2015 was 600 units, which means the opening inventory for 2016 is also 600 units. We have to multiply this inventory value by the full cost amount plus the production units. Production units is equal to 900 multiplied by 13 minus closing inventory. Closing inventory is 200 units multiplied by 13. This is equal to $16,900. This is the cost of sales, which means this figure is $16,900. Now let's calculate the other way. Here what we are going to do is we are going to calculate the sales units first. So sales units is equal to opening inventory units plus the production units minus closing inventory units. This is the same as before, but we are calculating the unit value first. This is this value and this is this value. This is this value. So the sales units is equal to 1300 units. Using this units value, now we can calculate the cost of sales, which is equal to 1300 multiplied by 13, which is equal to 16,900. We can get the same answer as before. You have to have a clear understanding about these two techniques because in the exam these will be helpful. Now let's do this example. If the opening and closing inventory were the same for 2017 and 500 units were produced during the year, now let's calculate and see what is the sales units for the year 2017. Sales units is equal to opening inventory units plus production units minus closing inventory units. They are stating that opening and closing inventory are the same. So let's assume that opening inventory is X plus the production unit is 500 minus closing inventory. Closing inventory is also X because opening and closing inventory are the same. So what will happen now? These two X values will be cancelled each other out. So the sales units is equal to 500. Now we can calculate the cost of sales. Cost of sales is equal to 500 units multiplied by 13. 13 is the full cost per year, which is this value. So cost of sales for the year 2017 is equal to $6,500. This is how we can value the inventory and calculate the cost of sales. This point here is very important. In the exam, they will use this phrase, meaning opening and closing inventory are the same. So you have to quickly use this formula and find out the sales units. Meaning of the opening and the closing inventory being the same is that the business was able to sell all of their production units during the year. Meaning production units was equal to the sales units. They have sold all the production units during the year. So the opening and the closing inventory will be the same. Now let's discuss about the advantages of absorption costing. Absorption costing helps in better product pricing by allocating all manufacturing costs to the products produced. Because under absorption costing, we consider both variable and fixed production costs. Absorption costing is more suitable for long-term decision making since most of the fixed costs become variable cost in the long run. Absorption costing is more suitable for routine production industries. Absorption costing provides a better understanding of the cost of production, which helps managers in making informed decisions related to various aspects of business. Absorption costing complies with accounting standards, making it widely accepted and used for external reporting purposes. This is really important. Absorption costing is complies with the accounting standards. This is the main costing technique which businesses use, which is also complies with the accounting standards. This is really important. Absorption costing allocates overhead costs to the products produced based on the level of activity, ensuring a fair allocation of these costs. Absorption costing facilitates budgeting and forecasting by providing a more accurate estimate of the cost of production, leading to better planning and resource allocation. Now let's discuss about the disadvantages of absorption costing. Absorption costing can distort the true profitability of products, especially when there are significant variations in the level of activity across different products. Meaning, if there are more than one products, the absorption costing will be distort the profitability. Absorption costing may discourage cost control, as managers are not held accountable for costs that are beyond their control. This is because almost all the fixed costs cannot be controlled by the managers, such as rent. The rent figure cannot be controlled by the managers. Absorption costing may incentivize overproduction, as it assigns fixed overhead costs to the products produced, regardless of the level of demand for the products. Think about this, how we calculate the FOAR. We divide the budgeted fixed cost by the budgeted activity level. If the budgeted activity level increases, what will happen to the FOAR? FOAR will decrease. This means the total cost of the product will decrease. So this will incentivize the overproduction because managers know if they can produce more products, they can decrease the FOAR. But in reality, this will be an overproduction, which means the company is producing more than the demand. So there will be a waste. Absorption costing can be complex, especially when it comes to allocating overhead costs. We know this already. Absorption costing may not reflect the economic reality of the business, especially in the long run. Thank you for watching. See you in the next video.